December 19th, 2024. I wanted to make a video today. It's still going to be a little bit of daily review, but it's more going to be based around trades I took and, how creating a system of trading develops into more trading and eventually develops into discretionary trading. And so if you've been watching my videos, if you haven't been, I'll go over it. But if you have been watching my videos, you know that I talk about 4-bar microchannels, and that's the sort of thing that I trade. These 4 bars, 3, 4, 5, 6. So let's highlight all the 4-bar microchannels today, right? We have one here. We had one that ended up developing down here. It ended up being 5 bars. And this was a 3-bar microchannel. I'm going to highlight it anyways. This 4-bar microchannel, but not closing near its low, not really breaking out of anything. And obviously, this is the end of the day. The object of the 4-bar microchannels is to catch breakouts for second legs. Something else I'd like to say before is this sort of sell-off. I don't personally trade Fed days, days where they deal with interest rates. And this is one of the reasons, because you can get such extreme moves. If you caught this move, really good job. I think you did a great job. But if you didn't catch the move, I wouldn't worry about it. You don't really get 250-point sell-offs very often, and this is extremely irregular price action. And irregular price action is irregular. So you want to get used to trading regular price action, and stuff like that is pretty rare. So I wanted to talk a little bit about 4-bar microchannels today and how I've been studying them over the past 3 to 4 months and the development in trading and how it transitions into discretionary trading. Obviously, this is a pretty straightforward one. You get, a big gap up. It's a trend line break from yesterday. So you're expecting a bear channel. This really was just the market cycle. Spike, pullback, and then weak bear channel the remainder of the day. So spike, pullback, channel. What's after channel? Probably trading range. So I am expecting a trading range. Maybe not tomorrow. We might have to get below here to test that low before we start a trading range, but we probably should end up getting a trading range. This was also a 4-bar microchannel. I'll highlight that. However, I've noticed that trading third legs is not very effective in 4-bar microchannels. I've also noticed that trading against tight channels is rather ineffective. So we had a pretty straightforward sell. I sold the close of 5, expecting at least another leg down. You have 4 straight bear bars. We're probably going at least a little bit lower. What's my calibrated expectation of this trade? Calibrated expectation means, what do you think is going to happen in the trade? If you're taking trades without a calibrated expectation, you are not going to end up making money. You might make money on an individual trade, but you're not going to make money overall. You have to think about what you're looking for in a trade. And so whatever the trade is you took today, what did you want to see in the next 5 bars in that trade? Really, depending if it's sort of a trending day or a trading range day, you can think about what did I want to see in the following bar. After selling a 4-bar microchannel, I found that you generally get a pullback. And so we had a pullback on bar 6. But it doesn't really need a second leg, an outside down bar on 7. We bounced 8 and 9. 9 might have needed a second leg. However, it never traded above, so I never got out. And then we got 14, 15, and 16, and I exited up in this area around break even. Why did I exit? Because this is no longer small pullback bull trend in my mind. No longer small pullback bear trend. And if you take your trades in spots where it's high probability, but you're expecting a pullback, you could just use small pullback trend expectations. So one of the examples I wanted to use was it wasn't a 4-bar microchannel, 55, 56, 57, but on a lower time frame, a 3-minute chart, I'm sure it was. Right. So it's a 4-bar microchannel. There would be my sell signal, right? Highlighted a little bit. This would be my sell signal. 5 bars because of doji bar, so I'd usually wait for a 5th bar and a second close below the moving average. But my point being, I know it's a 4-bar microchannel on some time frame, and so I'm selling below 57. And what are my expectations? My expectations are that we're going to form some sort of small pullback bear trend for 3 legs in a trading range. Why is that my expectation? Well, I know it's a trading range day. You can look at the structure of the day so far. You buy low, you sell high. And so I know selling the close of 57, 55, 56, 57, 75% chance that it's going to get a second leg, and probably 70 to 75% chance that we're going to get a pullback first. And so long as that pullback does not need a second leg, it's probably reasonable to stay in the trade. And I think that's the key to all of trading, is thinking about your calibrated expectation for the trade and really finding spots where your calibrated expectation is a small pullback trend. Because if you can do that and you can find those trades and get really good at that one specific type of trade, you can make a living as a trader. And so traders who sell the close of 57, expecting 2-3 legs down, what's their exit? For me, I exited with 10 points. So I sold here and I exited down here. I got out during 66, so it was somewhere in here. And my calibrated expectation was that we might get a pullback, but it would not be too deep. And if 59 had been a bigger bull bar closing on its high that I felt needed a second leg up, I probably would have exited. Now, what else? Does the 4-bar microchannels do? Well, I've been studying this very particular setup for a decent amount of time now, and so this is where the discretionary piece comes in. This particular channel is really important to me. You have a tight channel down, and so or I know at least because I've been studying it, whenever you're trading a 4-bar microchannel against a tight channel down, it's a bad trade. This is a better sell the close bar probably than it is a buy the close bar. If it's going to work, if you're buying the close of 24 and it's going to work, we're gonna rally pretty quick. We probably won't get 25, but if we do get, if you bought and you got 25, you can stay in the trade. But after 27, you have to get out of the trade because it's going to sideways. You're buying against a tight channel. And if you're buying against a tight channel, you want immediate follow through. You don't want the market to go sideways because this is a breakout on a higher time frame. And so this is looking like a pullback. So for me, at some point in time, I used to buy the close of 24 and then watch myself get stopped out. And I'd done that enough times that I started to recognize, okay, when I'm trading against a tight channel, it's probably better to not take the trade. And today I thought about, what is the bar in which when I was long, I would think that my trade is in trouble, and that bar would be 29. When I see bar 29, let's say I had bought the close of 24. When I see bar 29, I think I'm probably going to get stopped out. That would be my first train of thought when I see bar 29. So I decided not to buy bar 24, and I decided to instead wait, and I sold the close of 29, thinking that this bar would have troubled me a lot had I bought somewhere in here. So you can see how if you're developing a system to trade in one particular way, it eventually branches out into all of the market and you learn how to trade in a discretionary way via the lens of the system that you're trading. So for me, with this 4-bar microchannel system, selling the close of 29 obviously is not 4-bar microchannel. However, I do know that if I had bought this close, this is probably the bar that would make me think that I'm in a lot of trouble. And vice versa, it works the other way as well. If I had bought the close of 24, or I had not, let's say I didn't buy the close of 24, right? And then 26 closes on its high. Well, if this trade is going to work, if this trade against a tight channel is going to work, 26 would close on its high and get really fast follow through. I know that because I've seen it and I've studied it. So for me, I know that buying the close of 26 if 26 closes on its high, I can probably buy above the bar and expect 27 to be a big follow through bar. Something like 22 probably, or maybe 15, or maybe 23. That's or 42. That's called my calibrated expectation, right? You cannot just buy above, let's say, again, this is assuming 26 had closed on its high. You cannot just buy above the bar and hope that it goes up. And if it doesn't, just, oh, well. No, if you're buying above the bar, you have to know the situation of the buy, and you have to understand what it is that you're trying to accomplish with your trade. So your calibrated expectation is what it is that you're trying to accomplish with your trade. And you need to be very clear on that, because the reality is you can buy or sell any bar in the stock market so long as your calibrated expectations are really, 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 really fine tuned. Obviously, that's a little bit of an exaggeration. You want to put your money in good spots, but you have to keep in mind, like I keep saying, your calibrated expectations. So, if I'm selling, let's say the close of 3, I know it's a swing trade, right? So I'm selling below 3, and I know that I'm probably not going to get a big follow through bar. I'm probably going to get something disappointing simply because it's not a high probability trade. So what's my calibrated expectation? Well, I want a big follow through bar, something like 72 or 74. And then I get bar 4 as follow through. Is that enough follow through? In my mind, that's enough that I'm staying in the trade, but it's not enough to make me add to the trade or think that it's higher probability. So I think when I see 4, the probability is still relatively similar. And I would probably have to wait, just adjust something. So what do I want to see on bar 5 if I sold below 3? Well, after 4, it's a pause bar, so I want to see 5 be a good bear bar closing near its low. Okay, it is. But what if 5 was a disappointing bull bar, even a doji bar? Well, then I would probably exit the trade. And it's still reasonable to hold if you wanted to and exit when the other side needs a second leg, but that's more reasonable for higher probability trades. So for lower probability trades, in my opinion, your expectation should be relatively fast follow through until it turns into a high probability trade, and then you can get a pullback and trade in a way that you're waiting for the other side to need a second leg. So for example, 3, maybe not necessarily the highest probability. You don't want a bull bar on 4, But after 4 and 5, a bull bar on 6 is okay because it's a 4-bar microchannel and you know it needs a second leg, so long as 6 isn't big enough to need a second leg. So again, this was more of a trading review necessarily than a daily review, because chart reading is important and it's cool and stuff, but you can be a really good chart reader and not a great trader if you're not thinking about it the correct way. So this is essentially a trading review of the E-mini for today. And yeah, that's going to be it.